Welcome back to our intermediate financial accounting class. Over the last couple of segments we've been talking about liabilities, a little bit about liabilities in general, but mostly about current liabilities. And we've done some examples of determinable liabilities. And we talked about contingent liabilities. We'll talk about them and do some examples of them a little bit later. For now, we've done some examples of short-term loans. Now it's time to talk about what I call the revenue payables. So take a look at this first example. The first of our revenue payables are sales taxes. Now this is a reality of life for most of us. When we go to buy products, we know we're going to be charged the sales price plus a sales tax. Now you might be lucky enough to live in a state and a city that don't charge any, but most of us end up paying at least some. And most companies, because they cross state lines or city lines or county lines, etc., even if they don't have to charge sales tax everywhere, they do have to in certain places. As a company, we're obligated to collect that tax and then send it into the government. For some reason, the governments don't believe that we as consumers will keep track of what we owed and send it all in later. So the law requires companies to keep track of this, and every time they make a sale, they collect some sales taxes and occasionally remit them back to the government. And that's what we want to take a look at, is what do these entries look like. So let's start then with this sale that Turkeys Incorporated has made. They sold 25,000 turkeys to a grocery store chain for $5 each. We want to make the journal entry to record the sale if the sales tax in their area is 6.25%. Now I wish I could give you a set number and say sales tax is always about this, but it varies so widely. There is no rule of thumb. For example, South Dakota sales tax is supposed to be 4%, but in the city where I'm living right now, we pay the 4% to the state, and then there's an additional almost 2.75% that is paid to the city. So there really is no way to know exactly what the sales tax is in your city except by grabbing a receipt and looking at what they charged you down at the bottom. It also can get really exciting because some states say you can charge sales taxes but not on food or on everything, or taxes always get to be really complex, which is why I do financial accounting, not tax. But just be aware, you're going to have to look up and find what the sales tax is for your area or for the area where your company is making the sale. It's another reason why companies have big accounting departments and gives us more job security, because somebody has to know what all the different sales taxes are in all the different areas and remit all these payments at the appropriate time. So it's big business, both for the government who are collecting the revenues and also for accountants who get hired to keep track of all this money. Let's go ahead and do our journal entry for this sale. So the first thing we need to figure out is how much money is coming in total. So we're selling 25,000 turkeys at $5 each. So the total the grocery store owes us, Turkeys Incorporated, is $125,000. They're going to pay a little more though. So let's figure this out. The total sales revenue times that sales tax rate. And we'll just round this to the nearest dollar. Comes out to $78.13 as the amount of sales tax that has to be collected. So now we can do a journal entry. First, we're going to record sales revenue for the $125,000. Then we're going to collect this in cash or accounts receivable and send it to the government. So we as a company now owe the government $78.13. And our debit will either be the cash, or it could be accounts receivable if they're buying this on account for that total amount. So $132,813. This is what the company pays us. This is what we get to keep, and this is what we have to remit to the government. The sale of 25,000 turkeys. Now usually state and local governments, they have a specific timetable. You have to pay once a year, you have to pay once a month. Most of the time it's once a quarter that we have to remit these payments, and that journal entry is really simple. Sales tax payable, we'll just assume we're going to pay for just this one order. Paid sales tax collected. And we would just take all the money that we've collected, we get to that deadline, we send a check, that's it. If you're a savvy company, you use the opportunity over these 3 months to invest, maybe make a little money on the side that you can as interest revenue or dividend revenue while you're waiting to remit the money to the government. But one way or another, that check's going out every quarter or every month, whatever the law is. And that's all there is to it for sales taxes. Pretty straightforward, as long as you remember to do it. The other revenue payable is unearned revenue. Unearned revenues are revenues we collect up front and then we provide the good or service later. So in this case, the company has come in at the beginning of December and placed an order for 600 turkeys to be delivered in January. Why? Because they're missing the holidays, I don't know, but it works out. They're going to give us the money today. We're going to send them these turkeys later on. One of the important concepts with unearned revenue is the fact that we can't record the revenue. If you remember, revenue recognition now requires 3 elements. Number 1, you have to identify the contract. That would be the order that we receive from the client. Number 2, we have to go through the contract and find our obligations. In this case, there's only one, delivering 600 turkeys in January. Number 3, we figure out how much revenue is being offered for the obligations we've taken on us, and that would be the $5 sales price per turkey times the 600 turkeys. Number 4, we allocate that to our obligations. Well, we only have one obligation and one revenue number. That's pretty easy. All of it goes to this one obligation. And then as we perform the obligation, we get to recognize the revenue. Well, if our obligation is delivering turkeys in January, I don't get to recognize the revenue until January. So I get the money now. Instead of recognizing the revenue, I recognize a liability. I owe them these turkeys. And once I deliver the turkeys, then I get to recognize the revenue. So we're going to make the journal entry then for this early payment. And there's 2 pieces to this. Number 1, we have a sales price. Number 2, we now have the cost. So we can go ahead and record the cost of goods sold for this as well when it becomes necessary. This is our unearned revenue. On December 1st of year 1, we get cash. How much cash? So normally we would take, 600 turkeys, $5 each, that's how much cash we're getting. But we've learned something important. That is, we have to charge the sales taxes as well. So we're really going to get cash for 600 turkeys times $5. It's going to give us $3,000 that we get to keep, but we're also going to charge this sales tax, and that's going to be $188. So we're going to collect cash of $31.88. We'll record sales tax payable for $188 and unearned revenue for $3,000. And this is a prepayment received for January delivery. We've done a lot of examples now with Turkey Incorporated, or almost finished a bunch of examples. Before we go on, I just want to take a second and tell you the real reason I use Turkeys Incorporated as a company. It's partially because in the fall when I teach this, it's about Thanksgiving time. But the real reason is because of an experience I had when I first started college. See, I started at a small junior college, Snow College in Ephraim, Utah, the thriving metropolis. Actually, they have a stoplight now and a Walmart. They're really growing since I was there. Anyway, this campus was surrounded by farms, and a lot of them were turkey farms. Now, before I go any further, I want to make it very clear. I did not own a car while I was at college, at least not while I was at junior college. Make sure you keep that in mind. I want to make sure you know that I was not part of what I'm about to tell you. I did not own a car. Anyway, so there were all these turkey farms around the college campus. Out of ways, there was the university in the city of Ephraim, and then around the city, really, were these farms. And while I was there, they were experimenting with this new brand of turkey. They genetically altered these birds so that they would build up faster and get muscle weight quicker, so that farmers didn't have to feed them as long before they were ready to be sent to market. The problem is that these turkeys had a weak heart. It was one of the negative consequences of this genetic manipulation. So the fun thing to do on a Saturday night in this little teeny town, apparently, again, I had no car, I wasn't part of this, but what college students would do is they would pile in the car and they would drive up to one of these turkey farms, quiet, with the lights off. They'd get right up to the gate, and then they'd honk. And it would scare the turkeys so bad that they would have heart attacks, and they would fall over and die. And Anyway, they did this quite often. Apparently it got so bad that they stopped using this particular breed of turkeys around the college campus. They still use them, I believe, in other places, but they had to move them farther away so the college students wouldn't keep killing them by honking their horns. Again, I didn't have a car, but it was a very funny story, at least funny the way that I was told about this experience. And it was a turkey farmer who told me about it. He didn't think it was as funny as the rest of us did that were hearing his story. But anyway, that's the real reason for Turkeys Incorporated, is because of this story I was told by a turkey farmer back when I was in junior college. We need to finish this off by showing not just what happens with the unearned revenue, but how we get rid of the unearned revenue. On January 5th of year 2, I'm now going to send them these turkeys. So I'm going to get rid of my unearned revenue, because I have now earned it. And I'm going to recognize it as sales revenue. I've delivered the turkeys, I've done my piece, I've finished the 5 steps required under the new revenue recognition rules, and I'm good to go. Since I've made the delivery, now I would recognize cost of goods sold and inventory. 600 turkeys, $3 a piece, what it cost me to raise them. So $1,800, I'll bring that over here. This is the delivery of 600 prepaid turkeys. All right, that finishes our example of the revenue payables. When we come back in our next segment, we'll be talking about the next set of determinable liabilities, and that is payroll. I'll see you then.